Hello friends. Friends, we are going to continue with cash flow statement. Right? In this, we have been discussing about cash flow from operating activities. In the last lecture, we did some practical problems on this cash flow from operating activities. Right? So, in the last lecture, we did two practical problems on this. In this lecture also, we are going to do some practical problems on cash flow from operating activities. Clear? So, there are three important things. I told you in the last lecture also that when you get the question on cash flow from operating activities, the first step is to identify the items which are directly related to net profits, right, which are directly related to non-cash and non-operating items, and thirdly are current assets and current liabilities for working capital changes, right. So basically we have the three steps in cash flow from operating activities. The first is net profit, second is non-cash and non-operating items, the third is working capital changes. Clear? Okay. Now, let's see a practical problem on this. Sunshine Limited reported net profits after tax of 3,40,000 for the year ended 31st March 2016. The extracts from the balance sheet for 31st March 2016 and 2015 are given to us. We are given the balance sheet extract for 2 years. In that we are given the inventories, trade receivables, prepaid expenses, trade payables and provision for taxation. Then the further information given is depreciation charged on plant and machinery is 49,000, insurance claim received rupees 20,000, and gain on sale of investments of 8,000 appeared in the statement of profit and loss for the year ended 31st March 2016. Calculate cash flow from operating activities. Clear? Now, first of all, what we need is net profit. We are given in the very first line that Sunshine Limited reported net profits after tax of 3,40,000. So we'll start from here, right? We'll say cash flow statement. Right? Cash flow from operating activities. Clear? So the very first step is net profits. What we are given are net profits after taxes. We're given the net profit after taxes are 3,40,000. Clear? Now, are there any items related to the net profits? Right? We have to reach at net profits before taxes and extraordinary items. So first of all, we have to identify those items which are directly related to the net profits. Right? Inventories? No. Trade receivables? No. Prepaid expenses? No. Trade payables? No. Provision for taxation? Yes. Right? For the current year's provision for taxation, we will adjust the net profit by add provision for taxation, right? Current year. This is 13,000. Clear? The current year's provision for taxation will be added back because it does not involve the actual cash outflow. We are just creating a provision for paying the tax in the future. Clear? Now, depreciation related to net profits? No. Insurance claim received rupees 20,000. Is it related to net profits? My answer is yes. Can you tell me how it is related to net profits? I say that we will adjust this item from net profits after taxes. Now you will tell me why we are going to adjust this. See, in a particular year, there was a fire in your godown where your stock was lying. Right? In a particular year, your stock got destroyed by fire in your godown. Right? That stock was insured. Now that event of stock getting damaged by fire, it is an ordinary event or extraordinary event? Obviously, it is an extraordinary event. That event which is not happening again and again in the business. This is beyond the control of business. That is an extraordinary event. On that extraordinary event, you have received the insurance claim of rupees 20,000. For the stock that got damaged by fire that was insured, and from the insurance company this year you have received an insurance claim of rupees 20,000. Right? So when you have received some amount, you have received 20,000 from insurance company, you must have added back in the profits. Now, when we are to calculate net profits before taxes, what we do is we adjust extraordinary items. I told you that if there is an extraordinary income, that will be subtracted, and if there is an extraordinary expense, that is added back. Right? So, I'll say less insurance claim received. Right? Because this claim, the amount that you have received, you must have added back. Now it will be subtracted. The amount is 20,000. Anything else related to net profits? Depreciation? No. Gain on sale of investments? No. So that means we have reached at net profits before taxes and extraordinary items. Clear? Clear, friends? So this amount is 3,33,000. Now, what is the next step? Can you tell me the next step? Adjustment of non-cash and non-operating items. Clear? Now, from the net profits before taxes and extraordinary items, we are going to adjust the non-cash and non-operating items. Now, let's identify which are the non-cash and non-operating items. Inventories. So, this is our current asset. Trade receivable, this is our current asset. Prepaid expenses, this is again our current asset. Right? Trade payables, this is our current liability. Provision for taxes, we have already adjusted. Depreciation charged on plant and machinery, rupees 49,000. Yes, this is a non-cash item because depreciation does not involve the actual cash outflow. Right? So I will add back depreciation. Right? Depreciation of 49,000. What else? Insurance claim that we have already adjusted. Gain on sale of investments, rupees 8,000. Now this gain on sale of investments, is selling investments the routine operations of business? No. Then the gain on sale of investments is nowhere related to the routine operations of the business. So this should be subtracted from the profits less gain on sale of investments, right? How much is the amount? It is 8,000, right? So now what we get is operating profit before working capital changes. What is this figure? 3,74,000. Clear? Now, what is the next step? We have completed 2 steps. Net profit we have calculated. We have adjusted the non-cash and non-operating items. Now the next step is working capital changes. Right? Now, in the working capital changes, let's see, inventories. Last year, our inventory was 72,000. Now our inventory is 69,000. Right? Inventory is what? Current asset. There is a decrease, or I can say fall in the current asset of 3,000. Now, the decrease in current asset will be added back or subtracted. Remember the rule. Current assets move in opposite direction and current liabilities move in the same direction. The fall in current assets will be added back. So, I will add back inventories to the extent of 3,000. Right? Now, next. Trade receivables. Trade receivables is our sundry debtors. Earlier, the sundry debtors were 61,000. Now they have increased to 94,000. Right? It is our current asset. Our current asset has increased. The current assets move in opposite direction. The increase in current asset will be subtracted. How much is the increase? This is 33,000. So it will be subtracted. So I can say less trade receivables. How much? 33,000. Clear? Next. Prepaid expenses. Prepaid expenses is again our current asset. Right? This you all know. Our current asset has increased from 3,000 to 14,000. There is an increase of 11,000 in the current asset. So any increase in current asset will be subtracted because the current assets move in opposite direction. Prepaid expenses is 11,000. Clear? Next, trade payables. This is our sundry creditors. Earlier, the sundry creditors or trade payables was 78,000. Now, the amount is 82,000. So, there is an increase in the liability of 4,000 and the current liabilities move in the same direction. That means increase will be added back. So, I will say trade payables. Clear? 4,000. Anything else related to the working capital changes? I think we have covered. Provision for taxation we have covered. Depreciation we have covered. Insurance claim we have covered. Gain on sale of investment we have covered. So what we get is, this is cash generated from operations, right? This figure comes to 3,37,000. Now on this cash generation from operation, what we do is, what is the next step? What is step 4? Payment of income tax, right? Less income tax paid. Now, is there any tax paid? See the balance sheet. Is there any tax paid? Can you tell me? I say yes, there is a tax paid. What is your opinion, friends? There is a tax paid of 19,000. You will say, sir, that is a provision for last year. Why we create provision? Because we have to pay that amount in the next year. Last year, 19,000 was the amount created as provision for tax, because we know that next year we have to pay a tax of 19,000. So in the current year, we always assume that this 19,000 is tax paid in the current year. Clear? Provision created last year is for the tax payment in the next year. So in the next year, that is the current year, we have paid the tax, we have paid the provision of 19,000. So what is this figure we get? This is cash generation before extraordinary items. What is this figure? This figure comes to 3,18,000. Now, is there any extraordinary item in the question? We have already discussed it. Yes, insurance claim of 20,000. Now, this is the income that we have received. If this is an income, what is to be done here? Earlier, we subtracted the income. Now, we will add back the income. We'll say add back insurance claim received amounting to rupees 20,000, right? So this is the figure of cash flow from operating activities. Clear? Clear, friends? I hope this much is clear to you. Right? So this is how we calculate cash flow from operating activities. Here the important point was, one, this income tax paid, and the second was this insurance claim, the extraordinary item. Right? Make a note. Provision for tax created last year is assumed to be paid in the current year. Provision for tax created last year is assumed to be paid in the current year as income tax. Clear? The current year provision we add back while calculating the net profits before taxes, and if there is a provision appearing in the balance sheet for the last year, that we will assume that we have paid the income tax. We have used that provision, right? And we will subtract from cash generated from operations. Clear, friends? I hope this much is clear. Right? So, one or two small points I'm going to discuss in this. Talking of goodwill, if we talk of goodwill, what we have done so far? We have said goodwill amortization, right, or written off. This is the same thing, right? That means earlier in the books, that is on 31/3/2015 and 31/3/2016. In 15, your goodwill was appearing in the books at 1 lakh. Now your goodwill is appearing in the books at 70,000. That means we have reduced the value of an asset, but there is no actual cash outflow. In that case, we add back this non-cash item to the net profit before taxes and extraordinary items, isn't it? You know how to treat goodwill amortization, because why we add back? Because it is an expense, but there is no actual cash outflow for this expense. It is a non-cash item, right? It is a non-cash item. Clear? But in case I say on 31/3/2015 and 31/3/2016, on 15 your balance in the goodwill was 1 lakh, on 16 it is 1,50,000. Now in this case your goodwill has increased. In this case your goodwill has increased. But will you show this increased goodwill? Will you show this increased goodwill in your cash flow from operating activities? Just tell me. There is no cash outflow, there is no cash inflow. It is a non-cash item. It will not to be treated in cash flow from operating activities, right? It will be treated as cash flow from, it is an investing activity in case the goodwill amount is increasing. Clear? Clear, friends? So this is one small point regarding the goodwill I wanted to discuss. I hope this much is clear to you. We have two more issues regarding the operations. One is fixed asset and one is provision for taxation account. Right? This we will discuss in the next lecture. Right? So in the next lecture we are going to discuss about fixed asset account and in the next lecture we're going to discuss about the fixed asset account and the depreciation account. Okay, accumulated depreciation account. We are going to discuss about the fixed assets. Clear? So that's all for this lecture, friends. Thank you so much.